Good evening, I'm Adrian Seet and this is Bizworld. MBSB Bank and Bank Simpanan Nasional (BSN) are the first two banks that joined the Employees Provident Fund (EPF's) account to support facility, which will be implemented in two phases. Application for Phase 1, which begins this Friday, will open for 1 year. Eligible members who are 40 years of age or older may apply, while for Phase 2, members under 40 years old will be announced in due course. Under the facility, all Malaysian EPF members below the age of 55 can submit an advance notice for the age 50 or 55 withdrawal, provided they have a minimum amount of 3,000 ringgit in their account too. The maximum financing amount has been fixed at 50,000 ringgit, subject to the account to balance, with a repayment tenure of up to 10 years. The interest rate under this program will range from 4 to 5%. The EPF is also considering to add more participating banks in the future. Foreign funds returned to Bursa Malaysia last week after 4 consecutive weeks of net outflows, with a net buy of 11.5 million ringgit worth of equities. According to MIDF research, it was a weak start last week as Monday saw a net foreign outflow of 80 million ringgit by foreigners. However, the sentiment improved from Tuesday onwards after the data released by the Statistics Department showed that the producer price index shrank by 0.8% in February. The contraction was attributed to the base effect and lower prices of primary commodities. And the research firm noted that Friday last week saw the highest net foreign inflow of 59.6 million ringgit. Large investments achieved by the country, especially through foreign direct investment, needs to be seen in terms of the impact and not just on value. Bank Negara Assistant Governor Fraziali Ismail said investments rather need to be focused on the value they bring to the country. This includes helping economic complexity, creating high-value jobs and new economic clusters. Meanwhile, Fraziali stressed that Malaysia needs to implement major structural reforms to increase the country's competitiveness and growth potential. These initiatives will reduce cost of living concerns, build buffers against future shocks, and support the transition to become a high-income country. Saudi Arabia and other major oil producers announced surprise cuts totaling up to 1.15 million barrels per day from May until the end of the year. Bank Muamalat Malaysia's Chief Economist Muhammad Afzal Nizam Abdul Rashid said the move suggests that inflation could stay elevated if oil prices remain on the high side. The benchmark Brent crude oil rose by 5.7% to more than $84 per barrel. The ringgit retreated from its gains last week to open lower against the US dollar as the surprise move by OPEC Plus affected market sentiments. This is in line with most Asian currencies that fell, with the South Korean won suffering the biggest drop as the cut in oil output stokes fears about persistent inflation. Cuts by Saudi Arabia, Iraq, the UAE, Kuwait, Algeria and Oman will top 1 million barrels per day, the biggest reduction since the OPEC Plus /2 million barrels per day in October. Russia, a leading member of the OPEC Plus, said it was also extending an existing cut of 500,000 barrels per day to the end of this year. Malaysia's Manufacturing Purchasing Managers Index, PMI, climbed to 48.8 last March, indicating an improving demand in the manufacturing sector. S&P Global said the latest reading pointed to the least market slowdown in business conditions since last September. While new order intakes moderated further, it is seen as mild as some firms are able to secure greater new order volumes. However, production volumes continued to scale back, indicating that the sector still has some ways to go before demand fully recovers. Moving forward, the firms are expected to be buoyed by a further softening in input price inflation, as inflationary pressures are well below those seen in the second half of last year. And that's all the time we have for Bizworld. I'm Adrian Seet. Thank you for watching and keep tuning in to TV3.